Good morning to all of you. I, Sunil Kumar, PGT Accountancy in Cambridge International School, Dasuya. I welcome to all of you in the e-learning program initiated by Cambridge International School, Dasuya. Today we are going to start new chapter, that is journal and ledgers. But before jumping into the journal and ledgers, let's recapitulate what we had done yesterday. In the previous classes, we had done rules for debit and credit. It is done by two approaches, that is traditional approach and modern approach. Here is the traditional approach in which three accounts are covered: personal account, real account, and nominal account. In personal account, there are three types of persons. Number one is natural person, that is human being. It is created by God, like Ram, Sham, Sita, Mohan, Krishan, etc. are natural person. Then artificial person. Artificial persons are the persons in the eyes of law. These are majorly big businesses, small businesses, hospitals, schools, colleges, etc. For example, Cambridge International School, Dasuya, Cambridge Universities, Oxford University, Apollo Hospital, Punjab National Bank, State Bank of India, etc. are the artificial persons. Then third type is representative persons. Representative persons, basically it covers expenses and incomes of a group of people or a person. It represents the expenses and incomes of a person or a group of person. It includes outstanding expenses, prepaid expenses, income received in advance, and accrued income. The rule which is applicable for personal account is debit the receiver and credit the giver. Real account. In real account, we majorly cover all the assets. Now, assets are of two types: tangible assets and intangible assets. Tangible assets are those assets to which we can touch, see. For example, land, building, machinery, plant, stock, cash, etc. And intangible assets, these are those assets to which we can only feel them. For example, goodwill of a company, patents, copyrights, trademarks, etc. For real account, the rule is applicable: debit what comes in, credit what goes out. And number three, nominal account. In nominal account, all expenses, losses, incomes, and gains are covered. So the rule here is debit all expenses and losses, credit all incomes and gains. For doing journal entries, these rules are very, very important. So we have to imbibe this rule by heart or learn these rules by heart. Here is the modern approach of debit and credit. There are types of accounts. It covers five major accounts: assets, liabilities, capital, revenue, and expenses account. According to the table, we will cover first asset account. When assets increases, it will be debited. When it decreases, it will be credited. Second, liabilities account. When liabilities decreases, it will be debited. When it increases, it will be credited. Capital account. When capital decreases, it will be debited. When it increases, it will be credited. Revenue account, revenue mean income. Revenue, when it decreases, it will be debited. When it increases, it will be credited. Expenses account, when expenses increases, it will be debited. When expenses decreases, it will be credited. So according to the modern rule, assets when increases debited, assets when decreases credited. Liabilities, that is just opposite of it. If liabilities increases, it is credited, decreases, it is debited. Liabilities and capital follows the same rule. If capital increases, then we will do credit to it. If it decreases, then debit. Revenue is our income. When income increases, it is credited. When decreases, debited. Expenses is vice versa. That is, if expenses increases, it will be debited. When it decreases, it will be credited. So we have to learn these two approaches by heart. And here the students get the liberty what rule they are going to follow in passing the journal entries. So this is the sole discretion of the student whether they are going to follow a traditional approach or modern approach while solving practical problems through journal entry. So journal entry is very, very important. Here we have to learn journal entries very prudently so that uh, our basic is very strong, because we have to pass journal entries in every each and every class, whether it is 11th, 12th, graduation, post graduation, MBA, etc. So we have to clear our concept in grade 11 so that journal we can do our best in journal by learning the rules or the approaches, and we should able to apply these approaches in passing journal entries. So hope you understand uh, the modern approach and the traditional approach for passing journal entries. Today we are going to do journal. First, we will learn the meaning of the journal, then its characteristics, then the format of the journal. Format mean the basic structure of the journal which we have to follow while passing journal entries, and how they are recorded in journal. But what are the basic things which we need to keep in mind while passing journal entries? Here is the meaning of journal. Journal is the primary book of account in which transactions are first recorded in a chronological order, that is, as they are entered into. Journal is also called the book of original entry, since all the transactions are initially recorded in the journal. Journal, we say it a primary book because whenever any transactions takes place, first we record those transactions in journal, that too in a chronological order. If first transaction happened in on 1st of April and second on 5th of April, it will be in a chronological order. 1st of April's transaction will be recorded first, then 5th of April, then 7th of April, and as the transactions takes place, the recording of transactions also passes in the same manner. Journal is also known as the book of original entry. This is very important point. Book of original entry. What is also known as journal. Since all the transactions are recorded initially in it, so it is also known as book of original entry. Here the entries are passed first, so that is why it is called books of original entries. Here are the characteristics of a journal. Number one, Day-to-day transactions are recorded in a journal in chronological order. It means everyday transactions are recorded as per their sequence. No transaction should be skipped or written on the next day. It is written on the same day when it happens. Number two, it is a book of original entry in which transactions are written before posting them into ledgers. We have studied in the previous slide that it is a book of original entry because on the very first stage, journal uh, transactions are recorded in it. That is why it is also called book of original entry. Third, it records both the aspects, that is debit and credit aspects of the transaction. Debit and credit aspect we have learned while we were learning uh, the rules, in which we have seen that um, the father of accounting said that every transaction has two aspects, that is debit aspect and credit aspect. In debit aspects we are taking something, while by credit aspect we are giving something against taking something. So every transaction which we pass, it would have two aspects, that is debit and credit. That is why it is called double entry system of bookkeeping. Number four, journalizing. Journalizing means recording a transaction in journal. When we are recording a transaction in journal, it is called journalizing the transaction. And the form in which it is recorded is known as journal entry. Okay, these are the characteristics of a journal. Here is the format of journal. There are 5 columns and 2 rows. Like first column is date column, second column is particulars column, third is ledger folio, fourth is debit for the amount of debit and credit for the amount of credit. There are 5 columns. Now, this is a format which we have to follow. It is very, very mandatory because it is made by the ICAI of India, Institute of Chartered Accountants of India, and it is the approved form or universally accepted format in which journal entries are passed. If students do not follow this format, then their marks will be deducted. So everything in commerce is done in format, and that format is universally accepted. Now, in the first column, we will write date of the transactions. In the second column, particulars. Here, two aspects of transactions are recorded, that is debit and credit. Debit and credit transaction aspects of transactions are recorded under particular column as per the double entry bookkeeping system. And here also the narration is written. Narration is a brief description about the transaction. In narration, we will make it clear that what has happened in the transaction. Number third column is ledger folio column. Here the number of ledger page is written. Page number 1, page number 2, page number 3. That is written in the ledger folio column. Number fourth, debit amount. Here the debit amount is written. Number fifth is credit amount. Here the credit amount is written. So we have to follow this format while passing journal entries. If students will not follow this format, their marks will be deducted and it will not taken as a journal entry. So student has to learn it, or they have to follow this format while passing journal entries. Now, recording in a journal. This is the way or the points we have to keep in mind while passing journal entries. Transactions recorded in the journal from business point of view following the business entity concept. Now, this is very, very important because when we record journal entries, we have to follow the business entity concept. It means business and the owner are two different persons. So business is a different person and the owner is a different person. Business is an artificial person, owner is a natural person. Whenever we are doing recording in journal, it means we have to apply the rules according to the business point of view, that is artificial person's point of view. We have to keep in mind the rules for debits and credit which we have just learned in previous classes, and today also we have recapitulated and applying the accounting concept and principles. These principles and concepts we have already learned in previous class. So to understand it in a better manner, let's do some examples. So here is the first example. Mr. Rana started business with capital of rupees 1 lakh. The transaction is recorded by passing the following journal entry. Now, Mr. Rana started business with capital. First, we have to see the accounts involved. Here, the capital and cash is involved. So, while passing journal entries, we have to draw first 5 columns, that is date column, particular column, ledger folio, debit amount, and credit amount. Now we are passing journal entry by applying the rules. Now from business point of view, the journal entry will be bank or cash account debit. In Mr. Rana is started business, so from business point of view, what is coming in business? That is cash or bank. That is, we are writing bank by because it can be a check also or by cash also. So if there would be a check, you can write bank, or if there was a cash, you will write cash. Now, cash is coming in the business, that is why cash account is debit. And what we are crediting, capital account is credit. So according, here is your wish, which rule you are going to apply. We have explained it in number 1 point. Bank or cash account is debited because it is received by the business, that is cash is received by the business. So what is coming in, what comes in debit, or cash is increasing, debit. It it's being an asset, cash is an asset. The rule by traditional approach is the real accounts rule, that is debit what comes in. So cash is coming, we are writing debit what comes in. If you are applying modern approach, then bank and cash is an asset, so increase in asset is debit. Okay, so here we are clear why bank or cash is debited. Now second point, Mr. Rana's capital is credited because capital is increasing. Now capital is increasing, it is being a capital account. The rule, that is for traditional approach, capital is related to person, that is owner is investing, so personal account rule is applicable. So credit the giver. So Mr. Rana's capital account, then that is why capital is credited. By modern approach, increase in capital is credit. So whatever approach you want to apply, you can apply as per your wish. So hope you all understand the first example of journal. Second example is purchased furniture from Raman Furniture for rupees 10,000 paid in cash. Here is the transaction recorded in journal. Furniture account debit to cash account. Your explanation is here. Number 1, furniture account is debited because it is received by the business. So what is coming in the business is debited. It is being an asset, so the rule by traditional approach is real accounts approach, real accounts rule, that is debit what comes in. So furniture is coming in the business, that is why we are debiting furniture. Or if you are following modern approach says increase in assets is debit. So furniture is debited. Credit, like cash is credited because it is decreasing. Cash is an asset, The rule by traditional approaches, real accounts rule, credit what goes out. Real account says credit what goes out. That is why cash is credited. Or according to the modern approach, decrease in assets is credited. So decrease in asset is credited, cash is an asset. Uh, Here is the question solved according to the traditional as well as modern approach. Third example is paid rent rupees 3000. Now the transaction we are recording here in the journal is rent account debit to cash account. Amount is 3000, 3000. Here explanation is given. Rent account is debited because it is an expense. Rent is an expense. That is why we are debiting rent. It's being an expense account. The rule which we are following it according to the traditional approach is nominal account. That is debit all expenses and losses. Rent is an expense. That is why nominal account says all expenses and losses debit. To cash, cash is an asset. Oh, sorry, or a modern approach, it says increase in expenses debit. Now, second, cash is credited because it is decreasing. The rule, traditional approach which is applying, cash is an asset. That is why real accounts rule is following credit what goes out. Or if we are applying modern approach, then decrease in asset is credited. So cash is credited according to uh, traditional as well as modern approach. Fourth example is interest received rupees 1000 in cash. The journal entry is cash account debit to interest account rupees 1000, 1000. Here is the explanation. Cash account is debited because the firm has received cash. It's being an asset. The rule, traditional approach, real account, that is debit what comes in. So cash is coming in the business. According to the traditional approach, real account is applied. Debit, the rule says debit what comes in. Or modern approach says increase in assets is debited. That is why cash account is debited. To interest, interest is credited here. In second point, interest received is an income. It's being a revenue account. The rule, that is for tradition, according to the traditional approach, nominal account is applied. All incomes and gain credit. Or modern approach, increase in revenue is credited. So according to the rules, we have done 4 examples, and these examples are explained with both the approaches, traditional as well as modern approach. Hope you all understood what we have done today. So these are very, very important rules, and if we learn how to apply these rules, we are able to solve, we are able to do journal entries. So hope you all understood today's lesson. Please practice hard. We are sending you the worksheet also for this. If you are not able to do these worksheets, no issues. We will solve it uh, in the next class. This is all for the day. Thank you for listening it very patiently. Hope you all understood what we have done in today's class. Tomorrow we will come with another topic or with another questions. Till then, stay safe, stay healthy, and stay at home. Thank you.